Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about VERTIV Holdings Co. quarterly report. VERTIV Holdings Co. offers a wide range of businesses and services, including design, manufacture, and service of critical digital infrastructure technologies, lifecycle management services for data centers and commercial environments, predictive analytics, and professional services for deploying and maintaining products, preventative maintenance, acceptance testing, engineering and consulting services, performance assessments, remote monitoring, training, spare parts, and software services products under various brands such as VERTIV, Liebert, Netsure, Geist, Energy Labs, ERS, Albayer, and Avocent. These services cater to various industries including cloud services, financial services, healthcare, transportation, manufacturing, energy, education, government, social media, retail. VERTIV Holdings Co. (VRT) stock has seen a significant increase of over 65.26% in the past year, driven primarily by robust demand for its critical digital infrastructure solutions. The main catalysts behind this surge include strong financial performance and raised guidance, with VERTIV consistently exceeding analyst expectations, surging AI-driven data center demand, which has led to record orders and a growing sales backlog, expanding profitability and margins, with net profit margin climbing to 8.9% in the latest earnings report, strategic partnerships and product innovation, positioning VERTIV to capitalize on upgrade cycles and expand its addressable market. These factors have contributed to analyst upgrades and positive outlooks, with some issuing buy ratings due to promising long-term growth prospects driven by the AI revolution. The primary drivers of revenue growth or decline are multifaceted and region-specific. In the Americas segment, revenue growth is driven by a 43.6% increase in products revenue, a 38.6% sales growth, and a 39.1% net sales growth. Capacity expansion, artificial intelligence, and thermal management portfolio expansion also contribute to this growth. In contrast, potential drivers of revenue decline include trade and economic uncertainty, imposition of U.S. tariffs and foreign country retaliatory tariffs, global economic weakness and uncertainty, and fluctuations in interest rates. However, these are mentioned as potential risks rather than actual declines. Regionally, the Americas experience significant growth, while Asia-Pacific shows moderate growth. Europe, Middle East, and Africa experiences a slight increase in net sales despite a decline in other metrics. Overall, revenue growth is driven by a combination of factors, including capacity expansion, product and service sales increases, and regional market performance. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between Q3 2024 and Q3 2025. Net income has increased by 125% to $398.5 million, indicating a substantial improvement in the company's bottom line. This growth is also reflected in year-to-date YTD figures, with a 154.4% increase to $887.2 million. However, profit margins have shown contrasting trends. Operating profit margin has decreased by 2.9 percentage points to 19.4%, while net income margin has increased by 4.3 percentage points to 14.9%. The reasons behind these changes are not explicitly stated, but can be inferred as a combination of factors such as increased revenue, improved operating efficiency or cost control, and a decrease in non-cash expense items. The increase in net income is a positive indicator of the company's financial health, while the decline in operating profit margin warrants further analysis to understand its implications. The company's financial performance indicates a strong ability to generate cash from its core operations, with net cash provided by operating activities totaling $1,134.9 million. The company demonstrates a consistent and significant generation of positive operating cash flow over the given period. This trend suggests that the business is financially stable and capable of meeting its obligations, positioning it for future growth and success. The company's financial performance indicates a notable decrease in interest expenses over the past year. Despite maintaining a relatively stable debt level, the reduction in interest expenses is a significant improvement, totaling $50.3 million, minus 42%, from 2024 to 2025. This trend suggests that the company has made progress in managing its financial obligations and reducing its costs. The company's financial performance varied across different regions in 2025 compared to the previous year. The Europe, Middle East and Africa, EMEA, and Asia-Pacific segments performed well, with significant increases in operating profits. EMEA saw a 27% increase from $114.4 million to $83.5 million, while Asia-Pacific's operating profit rose by 55.3%. In contrast, the Americas segment experienced a decline in operating profit, decreasing from $303.4 million to $501.8 million, despite a notable increase in net sales of 29.7%. Management is optimistic about the company's future prospects, highlighting several key strategies to drive growth. These include expanding global capacity, acquiring strategic companies like Great Lakes, and investing in AI infrastructure to meet industry demands. Additionally, the company plans to continue growing its thermal management portfolio through new technology acquisitions. With capital expenditures projected at $225–275 million in 2025, management is committed to balancing short and long-term growth with responsible capital management. The company's financial summary reveals that it has engaged in share buybacks. This indicates that instead of distributing profits to shareholders through dividend payments, the company has chosen to repurchase its own shares from the market. Concerns about inventory buildup or supply chain disruption are evident in the company's recent financial summary. Rising total inventories from $1,244.40 2024 to $1,437.10 2025 on page 19 indicate a potential issue with managing stock levels. Furthermore, lawsuits have been filed citing inflationary and supply chain pressures on page 28. The company has also acknowledged difficulties in properly managing its supply chain and working with third-party manufacturers on page 30. Additionally, trade and economic uncertainty due to tariffs may impact financial performance, as mentioned on page 31. These factors suggest that the company is actively pursuing a supply chain strategy to mitigate risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for VERTIV Holdings Co. Feel free to comment below, and I will be happy to answer them when possible.